95% of all businesses worldwide don't sell. Why? Because the seller's trying to get rich off one transaction. He's trying to build his wealth off one deal. He worked 20, 30, 40, 50 years, and now he's trying to get wealthy. Wealth is built on a series of transactions, not one. Healthcare technology, which right now, cybersecurity is the hottest industry on the fucking planet. Cybersecurity is the hottest. You can't get it. I mean, if this was a cybersecurity deal, I could fry eggs on this fucking book. Why? Because every time Rocket Man in North Korea rattles his sword, or the guy in Syria, or Ayatollah, blah, blah, cybersecurity. There are 25,000 cybersecurity firms within a 50-mile radius of Washington, D.C. 95% of all businesses worldwide don't sell. Why? Because the seller's trying to get rich off one transaction. He's trying to build his wealth off one deal. He worked 20, 30, 40, 50 years, and now he's trying to get wealthy. Wealth is built on a series of transactions, not one. 95% of all businesses don't sell because they're asking outrageously high price for it because they didn't get rich all the way up. This system has created billions, tens of billions. It's the largest deal in recorded history, from teenage phenom multimillionaires to the largest deal on the planet, $500 billion, is built on taking money out every time you do a transaction. And this system is realize means sell, and either through an IPO or a strategic sale to a big company, and so you're cashing out. And that's how we've done it since I've been coaching 25 years, and that's how Amazon's doing it, and that's how Google is doing it, and that's how Microsoft is doing it, and I could go on and on and on and name many more companies. If your dog can't hunt in today's interest rate environment, you ought to jump in front of a car. And it's easier to buy revenue than it is create it. I'm going to say it again. It's easier to buy revenue than create it. And that's what the QLA program is all about, buying revenue. It takes a majority of the risk out of the deal because they've already generated the revenue. Now, for those of you that have been in business, your first $50,000 revenue, remember that first $50,000 you had in revenue? That's geometric growth, 0 to 50. And then remember the second $50,000 in revenue? That's still geometric growth, from 0 to 100. Why'd you stop? Because then you start coveting your assets. You start worrying about the money that you made. And you start worrying, more importantly, about losing it. So you sat down like a chicken, a hen on her eggs. A turtle can only move forward when its legs and head are out of the shell, right? When it pulls its head in and its legs in, it can't move forward, can it? Can't move anything. When it's in a riskless position, it can't move, can it? Most of your lives have been a turtle with its legs and head pulled in, because you've been risk averse. There's a completely different life from playing not to lose than playing to win. Right now, you will be motherfucking sidle over not taking advantage of the economic market now. Debt is good. The ghost says it's good too because the doors are going back and forth behind you. Debt is good. Greed is good, as Gordon Gekko said in the original Wall Street movie. But you've had 3 or 4 generations grow up, debt is bad. And guess what? You're more or less debt-free. The questions that you ask Kira and the questions you're going to ask everybody that's on the webinar are the same motherfuckers. And as one of the guys from the last seminar said, who's a professional salesperson, and he's one of the leading, if not the leading, Mercedes salesman in the country, UK, said to another professional sales guy that was in the seminar, they laughed. When they were having a pint or a drink, they both laughed at the kids, ask in different ways the same question, does it really get down to cold calling? The answer is yes. It really gets down to cold calling. And so the two sales guys that live and breathe sales, they chuckle because I never know you could ask that question 50 different ways. Because that's what's out of your comfort zone. And down deep inside, if you listen to anything on my site, it's pretty clear. Deal flow, how do you get it? You pick up the fucking phone. How do you get the fucking money? You pick up the fucking phone. That's not going to change. So consequently, do people that have come from a direct sales background have it easier? Yeah. picking up the phone. Are they any more effective? No. Why aren't they any more effective? Because they step on their dick in another way. The one that you're afeared of, they can do easily, but they step on their dick another way. Because you engage in self-sabotage, you will find the best way to step on your dick. Everybody in this room and everybody listening will find the best way to step on their dick and engage in self-sabotaging activities. And he wants to know, well, how do I stop the self-sabotaging activities, right? You don't! I have to go back to the second trimester when you're in your fat fucking mother's belly. You can't. It's not possible. But you got to get over it. Just like Kira said, when she was emotionally drained, I just pulled the trigger again. She said it a little more articulately than that, but that's what she meant. You got to keep swinging at the plate. As I said, there's two ways to buy a company. Buy assets, which is what I like to do, just the assets, not the company shares, because company shares comes liabilities present and future. Company assets are, for example, you're just buying the machines, intellectual property, yada, yada. My recommendation will be not to buy their shares. But they have tax basis, and they have all kinds of other things, so they're going to want to sell you the shares, and it's very seldom will they sell you assets, and they will sell you shares, because they're going to be advised by their accountants and their lawyers to sell all the liabilities, because if they don't sell the company and they're left with a shell, then they're stuck with the liabilities. So 3, 5, 10 years from now, some shareholder that nobody knew existed can pop up and cause them a huge problem.
What's the options?
No, well, the options are either assets or shares. And I mean, this is also covered. You get a deal on this, but 90% of the time you're gonna have to buy shares. 90%. But if you have your druthers, if you have your choice, buy assets. Always buy assets. And assets, but they're going to strip out the cash. Okay, but they also strip out the liabilities when you buy assets. And but I mean, when you buy a company, a unit, quite often, you'll tell them, if I'm buying the company with all present and future liabilities, you're leaving the cash in. And depending on how much the cash is, especially since you don't have 2 pennies to rub together and you need to pay yourself a salary, that you can take your first board of directors bonuses out of the cash that's left in the company. All of you, if you're in business and you don't have a line of credit or an overdraft, as they're called in Europe, something's not right. The rule of thumb is your overdraft, your line of credit should be 10% of your revenue. If you do $1 million in revenue, you should have 100,000 overdraft. Overdraft is a credit facility that you set up with a bank, normally guaranteed by your business revenue, and yourself, meaning you're going to have to sign for it. But it's money that they stands ready, not being used, in a separate account at the bank, the financial institution, that you can draw down on. If sales are off, you want to spend money on capital expenditures, CapEx, unexpected CapEx. Capital expenditure, all of a sudden you're doing so much business. Let's say you're manufacturing and clothing, you need to buy a new machine to do this stitching or whatever, and you go to the bank, and if you're in business, you'll be hard pressed to get an overdraft, but you've got no business, because the overdraft is guaranteed by the revenues of the business and by you personally. So, but for those of you that have businesses and that you have a few $100,000 in revenue or a few $1 million in revenue, you should easily be able to get an overdraft or a line of credit for at least 10%. So if you do $1 million, you can get 100,000. If you do 500,000, you should be able to get 50,000. And if the bank tells you no, next you go to another bank. There's no reason for you not to have an overdraft. I mean, credit cards have 5, 10, 15, 20, 25,000. That's the same or similar to an overdraft. The difference is, on a credit card, if you read the document, you're paying between 18 and 24% interest annualized. On an overdraft, you might be paying 1 or 2 or 3% over prime, over LIBOR, whatever the business rate. So that would mean you're paying 8% maybe, 7, 8, 9%, not 18 to 24% that you would pay on a credit card. Credit card rates are usurious, meaning, they ought to go to jail. And by the way, you can reduce your credit card, YouTube as well. You can reduce the rates you pay on credit cards Back in the day, I used to call credit card people every 12 to 24 months, and I'd say, I want to reduce, I want an extended amount. I want it to go from 20 to 30 or 20 to $50,000, and I want a reduced rate. And they say, no, I'm afraid we can't do that. I say, okay, I'll cancel the credit card. Then you go through 2 or 3 people, and then finally you get to a manager. And you say the same thing. I want to go from 25 to 50,000 on the credit card, or 5 to 10,000, whatever it is, and I want the rate to be reduced. And they'll say no, and I'll say, well, fine. Just like I told the other 4 people, cancel the credit card. They will not cancel the credit card. They will give you, okay, you now got 10, we'll give you 15. Or you now got 20, we'll give you 30. And the rate, okay, now you're paying 24, we'll cut it to 20. Or you're now paying 18, we'll cut it to 13. All rates are negotiable, including your mortgages. The only drawback, and it's not worth not doing it, but the only drawback for owner finance is as follows. Sometimes you're not able to owner finance in an overfinance way, so you can pay your accountants and your lawyers and take out money. If it's 100% owner finance, a good portion of the time, you're not going to be able to pull out money. A good portion of the time, you're not even going to be able to pay your accountants and your lawyers. Now, if you explain to your accountants and lawyers properly, and you follow the fucking script, roll fees, but you'll get paid out of the second deal or the third deal, they'll understand. But if you don't explain it to them correctly, they'll get nervous, and they'll send you an invoice. But that's the only problem. And we haven't got there yet. But we want to overfinance between 10 and 20%. We buy something for $1 million. We want to finance it for $1.2 million.
What percent?
20%. 10 and 20%. So we want extra $200,000. What do we want for the $200,000? 1, to pay the accountants and the lawyers. 2, put money up for ourselves. Now, if it comes down paying the accountants and the lawyers or paying us, you pay the accountants and lawyers first. And then you pay us. And if it comes down to, let's say you have $100,000 extra, and by the way, you're calling the overfinance working capital, and we'll talk more about that. We have $100,000 extra, and let's say that we have 5 members on the board. You'll take maybe $25,000 and you split $75,000 amongst the other board members. Now, sometimes you'll be so tight that you won't be able to take money out for yourself. I know this is a strange concept. You're just going to pay the board members and not you. And you're just going to continue eating at Taco Bell for 1 deal more. You will gain more credibility with your board members for not taking money. I don't take money when I'm chairman that often on the distributions, unless it's a big distribution. I don't. I say split it amongst the other board members. Because, 20 grand, I see Ansbach. It's not that big a deal to me. And so, but I know paying him an extra 15 is a big deal. Or paying him an extra 10 is a big deal. And yes, are we buying our loyalty? Yeah. But at least the next time you're going to have the loyalty. But fees to the professionals first, then distribution to the board members, and an overfinance. If it gets tight, the distribution to all the board members but yourself. And that's a hard call to make because, when you had your second notice for 2 months behind in your house, that's not an easy call to make. But it's the right call. High performance people fly like eagles. Eagles fly alone. Zuckerberg has no mates. Elon Musk has no mates. Steve Jobs had no mates. Bill Gates has no mates. And I can go on and on and on and on. They don't hang. They don't chill. They don't go to the Super Bowl. They don't go to the World Cup. Yeah. They don't go to Wimbledon. All they do is work. I fall into that category. I fall into that category. The richest woman in China, just an article in the FT a year or so ago, hasn't taken a day off in 26 years. There was a period of time from 1971 to 1996, I had no days off, including the day I got married. I worked in the morning. They just did a chart on me 2 years ago based on the hours that I've worked. I'm really not 70. I'm 131. I'm 131 years of 40 hours, 5 days a week, because I still work 60, 70 hours a week or more. I used to work 100, 110, 115 hours a week. When I was your age, I could work 4 or 5 days in a row with no sleep. Go out for a 10-mile run and come back and work another day. But the difference is I loved everything that I've ever done. Looking back in hindsight, I absolutely adored. I had great passion for it. Yeah. Because if you don't have great passion for it, it gets old quickly. It's like a girlfriend or a boyfriend, ladies. A boyfriend. After 2 dates, 2 nights, you want to kick him to the curb. And you're asking yourself, how did I get involved with this? So now you have one bank one financial institution that will fund your deal in this narrow gap, 3 to 5 times cash flow. Now, you can eliminate 99% of your search. Now you're devoted to the 1% that you can buy. First of all, it's got to have free cash flow. That means it's got to be making money at some level. Okay? Some level. And so you're going to know, well, I find you want 9 times cash flow. Forget about it. You want 6 times cash flow. Man, maybe I can work him down and get him within 5. 20 times cash flow. You eliminate. You don't talk to him. I don't care how good the deal is. We're only focusing on things we can buy.
Yeah, I was listening to the due diligence, but you first...
Yeah, okay. All offers are subject to due diligence. Sarge wants 6 times cash flow, and I know I'm going to be able to beat him down to probably 4 times cash flow, because when I go in there and look at the books and I start ripping out all the shit expenses and bullshit and it's fucking hooker and this and that, and we'll get him down to 3.5, 4 times cash flow. We got guys buying companies today for 2 times cash flow. 2. And people tell me, I'm paying 22 times. What are you, a fucking idiot? 2 times cash flow. We just did a deal, 2.4 times cash flow. So you hear all this, the smoke and mirrors, but when it gets down to the short strokes, motivated sellers. Remember? Guy had a stroke, the woman spitting up blood from emphysema. That's a Pena, perfect motivated seller. And there are people out there, maybe the old man spitting up blood from emphysema, and she had a stroke. I don't give a shit which way. And as Andrew said earlier, the one down the road, he had to come back and start running the company. He doesn't want to. He's 65 years old. That's a motivated seller. Not everybody wants to run. You know what your exit strategy is for most people? Falling dead across their desk. That's the exit strategy. We used to say falling dead in their in-basket, but they don't have in-baskets anymore. Falling dead across their laptop. Boom. Their head crashes through the, screen, yeah. That's the average exit strategy for the average moron business owner.